Can you hear me, Lucas?
Coming to you live from St. Louis, Missouri.
It's the FasterFreedom Show.
With your hosts, Sam Prim and Lucas Whoa!
We talking about freedom?
What's up, Prem? How you doing, man?
I'm doing well. How are you doing?
Doing good. You sound great.
I look great, too.
Yeah, as
Man,
usual.
It's one of those things. I look and sound and feel even more like an idiot than I usually do on
Oh,
Fridays.
man, that's all right. Don't be so hard on yourself, buddy.
Thank you. You know who I am going to be hard on?
This guy.
Tay. What's going on, Taylor Sohns? How are you?
What's happening, boys? Thanks for having me.
We're excited, man. I feel like I have a celebrity on our show. So you're our first virtual guest in our relaunch FasterFreedom Show.
Honor.
It
That's
is
an honor.
It's also like if it screws up, we don't care that it's
Yeah,
you.
test dummy. All good.
Yeah,
I'm used to that.
Yeah, exactly. So awesome. So we're going to have a great show today. I'll let Taylor introduce himself here in a minute, but Taylor and I became friends and started talking on social media probably like 6-8 months ago, maybe. We've gone live probably a half dozen times, and Taylor has a lot of really, really good insights on the market. Every time I talk to Lucas about like the stock market or finance markets, it's always just regurgitated conversations I've had with Taylor, and I tell them to Lucas. So it'll be a fun conversation. I'm like all in on real estate. Taylor's all in on like the markets. And Lucas is right in the middle.
Well, we talked about this last show, leverage other people's knowledge.
Yes,
right?
I'm leveraging Taylor's knowledge on a daily basis. So super excited to have you, Taylor. Before we get in, we're going to do a little icebreaker before you can introduce yourself to the audience. Are you ready for that?
Let's do it.
All right, go ahead, Walls. Ask me the first one.
All right, man. These are just some pretty generic icebreaker questions, all right? So first off, favorite and or most used emoji?
Oh, definitely the crying one. I'm always laughing. I think everything's funny.
Yeah.
Do you do the sideways laugh or just the normal old school LOL?
Straight up and down. The sideways laugh is like if I'm rolling over in my chair, I'll hit the sideways.
Yeah.
You've never done a sideways one in our conversations.
Yeah, because I'm always using the hand on face. Like, what are you saying, you monkey?
Yes,
Yeah.
that's true. Lucas says the same thing.
Yeah, not the most used emoji in your guys' conversation, like in general.
Yeah, in ours. My general's the face palm emoji or like the I don't know emoji.
Yeah.
Yeah, that one exactly. All right. So, what is your phone wallpaper, and what's the story behind it on your phone? Like your screensaver wallpaper on your phone?
It's super boring, but so important. I got my daughters on there, and my son is too young where I think the little infants aren't necessarily as cute, so he hasn't made it to the wallpaper yet.
He's right.
They're right.
He's just spitting facts.
Yeah, I know. They're like kind of like mushy and like haven't like it's like
Yeah.
lots of stuff's swollen, but that's like normal, and it's just they're just odd looking.
Just odd looking. But yeah, once they get into that toddler stage, they start to become a lot cuter. How old's your little boy?
I guess he's not quite 6 months, maybe 5 months old, somewhere in that ballpark.
Still in that stage for sure.
Yep,
He's
for sure.
still kind of ugly. All right, Lucas, that's the last one.
All right, man. So, does your current car have a name? And maybe let's go back to your first car. What was it, and did that have a name?
So I did call the first one Black Beauty.
Oh.
There you
And
go.
mind you, I didn't have a car for a long period of time. So I was like mid-20s, and I bought an old school side of the road used car dealership that you should never go to.
Yeah.
But it was a BMW, and the thing was fire.
Yeah.
I like that.
We have a
It
current.
was called fire, or you just think it was fire?
Yeah.
Oh, it was fire, man. It was black on the outside, like this cream on the inside. But as you get from a local roadside stand, a cheap car, it had some leaky oil issue that I didn't know what to do with.
I think we've all been there.
Isn't that a
Yeah.
Paul Wall song? Black on the outside, cream on the ears.
I
No,
think that's Duro.
Chrome on the outside,
yeah.
cream on the inside.
Yeah.
Come on, man.
I was
NASCAR pit
close.
stop.
Yeah.
I was close. Yes, he knows it.
Yeah, we've listened to that song a lot in your basement. I remember.
We did.
Yeah.
Yes.
Ice cream paint job.
Ice cream paint
Yeah,
job.
there we
I
go.
like it. That is awesome.
Black Beauty, I love that. My current vehicle, one of ours, our son named it Black Beauty, so that's a great name, Taylor.
You guys each.
Oh,
have-
that's what all the laughs were about. That's awesome.
Yeah,
Yeah, his wife has a big, nice Wagoneer, and his son called it Black Beauty. What does your son call your car or your truck, Lucas?
My truck is Rocky.
What does he call your vat?
Zoomer.
Zoomer. Nice.
Yeah.
You don't have a name for your? Don't you have a Maserati?
I sold the Maserati.
Okay, nice.
It's
What
such a don't bring it up, man. That thing was amazing, but at the same time, every time I got in the car, I just crossed my fingers like, check engine light, please don't come on
Yeah.
because the bill on this will be exorbitant. So
For sure.
I sold
Yeah.
the Maserati, I sold an Audi, and I got a Tesla.
Nice. Guess who else just bought a Tesla?
Your
recently?
dad.
My dad.
Mhm.
Good for him, right? Got
Yeah.
the Y. What model did you get, Taylor?
I got the Model 3
Nice.
and the fast one. And it is
Yeah.
like absurdly fast.
Yeah, like too fast. Like doesn't need to be this fast.
Scary. My dad got in it. We went down and got it. And he's like, dude, stop hitting the gas. My stomach's turning.
It's like me driving Sam's Lightning.
Yeah, it is. So what do you even call it? We talked about this the other day. What do you call it? It's not the gas. The
Yeah.
accelerator pedal because there's
Yeah.
no gas going on.
That's
but-
what I would call it, the accelerator
Yeah.
or the hammer.
Yeah, we're
Hit
we're
the
next
battery.
level
Hit the
here,
battery.
Taylor.
Yeah.
Yeah, hit the battery. Awesome. All right, so now that we got that out of the way, thank you everybody for joining. Throw any questions you have in in the discussion chat box. We will get to them if there's any fun one. But all right, now that we're all that goofiness out of the way, let's get into. And again, I apologize for my voice.
No, you sound good. Keep rolling with it, man.
Let's get into the topic. So Taylor, I will let you introduce yourself, sir. We've done this a couple times. Just let our audience that doesn't know you, just kind of introduce your backstory a little bit, and we'll dig into it a little bit. Just kind of the 30,000-foot view of your upbringing and your life after college.
Yep, after college. I went to college just outside of New York City, so kind of exposed myself to that Wall Street way of life, if you will, which was not at all reminiscent upon where I grew up. But went to work on Wall Street. I was what they referred to as an advisor consultant. And so what that is like they take educated people in finance and they take them and fly them around the U.S. to work with financial advisors. Now, the reality is a lot of financial advisors are salespeople, for lack of a better way of putting it. And so they actually don't have a ton of financial education, if any at all. And so they would bring clients in the door from their relationship skills, but then they didn't know what to do on the back end to actually invest the portfolios. So myself, my brother, who's my partner in the business, were like this traveling band of nerds who would go in and construct a portfolio for a financial advisor when they brought in a client that might have 5, 10, 100+ million dollars. So we did that for years, 12 years, I guess I did it for. And then I said, listen, I'm in a hotel 3-4 nights a week. This is ridiculous. I'm about to start a family. Enough's enough. And then so we broke off and started Life Goal Investments. And there's been a couple different iterations of Life Goal Investments, but what we are is a financial advisory firm. So we're totally independent. We don't work for Morgan Stanley, Merrill Lynch, Raymond James. Nothing wrong with that. But we took the independent approach so we could take kind of complete autonomy and do just what's right for the client, not worry about any corporate oversight.
Very cool. So we did a little digging on you. And aside from all the times you've been in jail, we found out, so when you were starting Life Goal Investments, what we hear on the internet is you had some of your former college football teammates kind of help you. Want to talk about that story a little bit, kind of bringing the team beyond the team?
Yeah. So my brother and I both played college football at Iona University, which actually the program was so prolific it doesn't exist anymore. That's how good we were. Yeah, so no, when we launched Life Goal, though, we brought in some outside capital from folks, and the first people we went to were our college teammates, and they, a lot of them were like, "Dude, I don't need to know what this is. I'm in." And so some of them needed a little more convincing than that. Don't get me wrong, but yeah, they helped fund the back end of the start of Life Goal Investments.
That's very cool. Yeah, Lucas and I are really good friends with a lot of our high school teammates. Lucas played basketball in college. I did not play anything in college, but yeah, that's a cool relationship you develop with teammates in sports. We've done several episodes and conversations about the similarities between team sports and business, and how a lot of that stuff is transferable, and that's always a cool comparison to make.
Yeah, and I'll tell you this, Taylor. I've heard of Iona. Like they're usually like that 15 seed on the March Madness brackets that I picked to upset the 2 seeds. So
did that ever work?
So
for
they
you?
still have a basketball program, I assume.
Yeah, they do. So Rick Pitino, who obviously is a famed college basketball coach, just left this past year. He went back to St. John's.
Yeah.
St. John's is in Queens, where he grew up. So that's why he wanted to do that. But yeah, the basketball program has been good for that mid-major, if you will. They make the tournament every year. They get smacked every year. And every year is a stretch. They don't make the tournament every year. When they win the MAC, the league they're in, they make the tournament, and they've done that a bunch.
Very cool. Very cool. I want to dig into a little bit on the funding of the initial startup of your business. Was that funds that you guys invested, or was it they invested into you as a company Taylor?
Yeah, the latter.
Okay.
So it was investing into us as a company, into the launch of the business on the front end. So yeah, not capital like the folks that we work with now are folks that are wealthy and don't know what to do from an investment standpoint to create the portfolio they need. That's not what our teammates and former folks did. They literally funded the back end of the business.
Okay, very cool.
Yeah, that is cool. So, you kind of explained it to me in our conversations, Taylor, that you feel like you got like the back end of Wall Street, going and analyzing everything and seeing what people with $100 million, what they do, and were able to construct and like kind of like, make their portfolios as risk diverse and as, however risk they wanted to be. And you take a lot of those strategies and you bring them down to people with $10,000, $20,000, $150,000. So do you want to talk about a little bit of the similarities you've seen and some of the advantages of being behind in these boardrooms with these ultra net worth individuals and how you're able to kind of cascade that down to the modern day people? Like you always talk, you grew up in a one red light town kind of people.
Yep. Yeah. So when you rewind back to where I started on Wall Street, I worked at what are the big asset managers. So like my brother worked for BlackRock, which is the largest asset manager in the world. I worked for a company called Legg Mason, Lord Abbett, Franklin Templeton. All of them manage upwards of $750 billion. And so half our days there were spent with the folks that are building out mutual funds, ETFs, et cetera, and deploying billions of dollars of capital and seeing why they're buying $500 million in mortgage-backed securities on a particular day and seeing the portfolio construction process. And then on the other end was when we were going out and working with high net worth individuals. And so we've constructed portfolios that are, $1 million. And then we've constructed portfolios that are literally, the largest one I worked on was an endowment in the state of Kentucky, $468 million. And so the reality is when you look at things beneath the surface, yes, someone's risks might be a little different, but at the end of the day, portfolios all have the underlying same portfolio construction at the core of it. And then from there, whether someone wants to be more risk averse or more aggressive in their nature, then it gets tweaked along the way. But the foundation, the fundamentals of all portfolios are really similar.
That's super cool. Is there a particular percent allocation on certain types of securities and whatnot that you would recommend setting up?
Yeah, good question. So that's going to depend on someone's underlying needs. So let's take a step back here. I'll kind of give you guys the foundation of
Taylor,
portfolio.
Luke asked a lot smarter questions than I asked. You weren't prepared for those, were you?
Well, I'm about to take that as a hanging curveball right now, Sam. That's an easy one.
Smash it.
So think about this. Like everyone knows what stocks are. So stocks are you're going out and buying a piece of a company. Now, when you buy stocks individually or buy the S&P 500, doesn't matter. What's the big risk to owning stocks? The big risk to owning stocks is a recession at the end of the day. So in a recession, you're going to have the economy contract, corporate earnings could contract, and stock prices will come down. And again, no one really knows when the next recession is going to hit. But when you own a stock-based portfolio, that's the risk that you have to offset. So how do you go ahead and do that? Well, let's take one more step back and think about things from an economic mentality and say, if we enter a recession, the Federal Reserve, what do they do with interest rates? They cut them. And what they want is mortgage rates to go from 7% down to 3%, which stimulates people to go out and spend money in the economy. Now, conversely, let's talk about bonds now. So if we're thinking about in a recession, the Fed will cut interest rates as stock prices come down. Bonds have an inverse relationship with interest rates. So as interest rates get cut, it forces bond prices higher. Beautiful. There's your offset to stock market risk, is owning a percentage of your assets in bonds. Now, a lot of people come to us and they say, hey, I own cash. There's my buffer for stock market risk. All right, cool. So think about this. As the stock market recedes in a recession, what does cash do? Nothing. Stays flat. In fact, it goes down in value a little bit. It doesn't technically. If you have $100 in a bank account, it'll retain that $100 stature. But what is the yield going to do as the Fed re-racks rates lower? Yeah. Your savings account starts to pay less. So cash really doesn't buffer stock market risk. So bonds really do. And so there's your offset. So the last thing I'll say now is, okay, when you have stocks, you have bonds, is there an underlying economic backdrop where they both get beaten up at the same time? Mm-hmm. And the answer to that is yes. That just happened in 2022. In 2022, inflation ripped. The Federal Reserve yanked interest rates higher. Stocks got smoked. The S&P was down 18. The NASDAQ was down 32. Bonds had their literal worst year ever. They were down 13%. So you're like, oh shit, now I have stocks and bonds getting smoked at the same time. What do I own that's going to help my portfolio? This is where you guys come into the equation. Things like real estate.
Yeah.
Real estate, hard, tangible assets go up in value when you have an experience where there's a massive inflationary pressure. So you invest in things like real estate, farmland, oil, gold, timber forest, critical infrastructure. And those are the three components of a portfolio that help you protect against any piece of the economic scenario that can play out, because no one has a crystal ball. When's the next recession coming? Bloomberg wrote an article 16 months ago. They surveyed 112 professional economists. 112 of them said we'll be in a recession in the next 12 months.
We're not.
They're all
yet.
wrong.
And a recession, and this is how smart I am. Recessions, one of those things you don't know until you're already in them. You know what I'm saying, right? Yeah. See, I learned that from Taylor. You didn't know that, Lucas, did you?
I think you've said that same thing like 5 days in a row.
Yeah, that's fine.
You know it.
I know
So
it.
might as
See,
well
and
share it.
And I'm still not that confident when I say
Leveraging
it.
knowledge.
Yeah, leverage knowledge. I'm still not even confident when I say it. I still kind of like, is that
Where
right?
did you hear this? You caught on to it wherever you
I heard it from him. That's funny. Awesome. So yeah, so having a mixture and
Yeah, I
having a
love that.
diversified portfolio is the right route for pretty much anybody. And you know, you talked a little bit before about isn't there like a, maybe I'm not remembering this correctly, but like a 70-30, isn't there like a traditional like split between the two, between bonds and stocks?
Yeah. So 70-30, 60-40 is the one that everyone talks about all the time. 60% stocks, 40% bonds. And if you look on social media, man, 60-40 is like, hey, any idiot, 60-40, you're good. 60-40 got torched in 2022. Both sides of it. Worst year ever for 60-40. I don't think it's the worst year ever. I think there was one year in history that was worse, but it was damn near the worst year ever.
So on the hard asset side of things, like maybe someone that's not experts in real estate like Sam and I, how are these people investing in real estate that you've seen that are maybe not experts in it?
Yeah, so there are different vehicles that you can utilize to invest in real estate. Obviously, there are publicly traded REITs, which are the real estate stocks. And then there's also bonds that you can invest in on the real estate, commercial mortgage-backed securities, etc. There's different people with different risk tolerances are more predisposed to owning one of those versus the other. And in fact, in our portfolios, we don't own publicly traded REITs. We own a different version of it and in a different format that's a little bit less liquid. So like, I'll give you a little bit more as opposed to beating around the bush. So where we buy real estate, we buy it in a fund that's called an interval fund. An interval fund has quarterly liquidity. So when you put your money into it, you can only access the money once a quarter. So think about the other side of this. If you buy an ETF that's publicly traded REITs, guess what happens? The ETF can be sold any day of the week. And all of a sudden the manager's sitting there with these, properties essentially saying, oh boy, the ETF flows just went out the door. Now I have to fire sale this stuff back onto the market. And hopefully there's people like you two, Lucas and Sam, that are sitting there going, hey, I'll buy that from you. Yeah. No, but in all reality, when you're buying a less liquid asset, you actually want to limit your own liquidity in the portfolio so the manager knows how much money they have to deploy, and there's never that fire sale type opportunity.
That makes sense. I like it. See, some of that stuff I taught Taylor, but anyways, so let's get into one of your favorite asset classes, Taylor, cryptocurrency. What just happened recently? We witnessed it live here on recently with Bitcoin. So we were hanging out. I think it was Wednesday, maybe, or I think it was Wednesday, right? Probably.
No, I think it was earlier in the week. No,
Tuesday or Wednesday. But anyways, this one Bitcoin, shot. Yeah, it shot from like 58 to 64,000, like literally in like 45 minutes, and it was just going like straight up. And then, it was like 63,000, and I was looking at my portfolio because I own a few Bitcoin, and I was like, holy crap, it's going like crazy. And we were like joking, should I sell? I'm like, no, I'm not going to try and day trade. I'm just going to ride this out to zero or a big number. And then Luke's was in a meeting. He texted me, Bitcoin's at 64,000 now. I was like, holy shit. So I went to my Coinbase app, and it showed $0, and it showed that the app is having issues right now. You can't access your funds to sell or trade. And I looked, and Bitcoin had like dropped down to like 58,000. I was like, holy crap! So what happened was they call it rugged. I got rugged. I'm pretty sure that a lot of whales started buying it and driving the price up. Then all the public got in, and then all the whales sold at one time. It shot down, and in order to avoid a complete collapse, Coinbase and other platforms just stopped people from being able to even access their funds, and then it bottomed out and then went back up. But anyways, it was quite the ride. It's back up to where it was. But anyways, I was like, wow, looks so illegal and so manipulative, but it's not. It's just like the GameStop thing, except it's not, regulated, so you can do it. So, anyways, that was what I saw from my end, actually living it. What did you make of that, Taylor?
Well, have y'all seen Dumb Money?
Yeah. Oh yes, so good. No one.
So
actually
doesn't it
got
just
in
like
trouble
ring
from that.
so many bells here?
Yeah.
Yeah.
It's the same thing.
But this one is I guess no one really got in trouble there, but this one is it's not regulated, so like this kind of stuff happens. Like, anyways.
But I don't think anybody ended up going to like prison for the GameStop scam. Is that correct, Taylor?
I would imagine that's true because
I don't think
I don't know anything more than you do from watching the movie. That's my extent of my knowledge there, and I don't recall anyone being put in prison after that.
Right, I agree. So yeah, what's your thoughts on the what happened with Bitcoin this week and then stopping trading in some of the platforms?
Yeah, so I literally have no more information on Bitcoin than you guys do. So I get questions from my buddies like, "Hey, what do you think about Bitcoin?" I'm like, I don't know. Toss a coin. My information and knowledge base is going to be about as good as tossing a coin. When it comes to Bitcoin, it's like, when it comes to a company, you can look at the underlying fundamentals, or a property, you guys can look at the underlying fundamentals and understand the cash flows, etc. When it comes to Bitcoin, at this point, there's nothing to actually tangibly put your hands on to understand what the value of it is. So I'm not also naive to the point that like sometimes people in the U.S. and big developed countries look at this and like, this is crazy. But I think you also have to look at it from the other perspective of like, and I don't want to be stereotypical and say sub-Saharan Africa, but that's what I'll say because you get the point of what I'm saying. In sub-Saharan Africa, if you're not confident in your own banking system, it's like, hey, why are we going to put our money here if we don't know it's going to be there? Whereas we could hold our value in Bitcoin, and that being an underlying true fundamental need for them. So I think there are some needs out there in the Bitcoin world. I think in the developed nations, we haven't really seen what that tangible use case is. But I don't know. It's one of those things that institutions just got in. And so that could absolutely be a tailwind that could propel it and continue it higher. But there's no downside gap measure on that where, if it starts to crumble, there's nothing underneath it. Hey, if this business crumbles, they own all of these assets. They at least have that tangible value. There's nothing there on Bitcoin. But also, you don't have the upside momentum that you can catch like in other companies like you can in Bitcoin. So it's a coin toss. You can tell based on me waffling around this answer that I have no more information than you guys do on Bitcoin.
No, I get it. And a lot of this opinion, and we've talked about it, I think you've kind of mentioned to me that, if somebody's got enough money and they don't mind it going to zero potentially, to throw a little bit in there, obviously don't have that be your retirement fund, don't have that be just as one of those potential upside things, which is what I've done, and it's stacked into a decent amount of money, but honestly, I would if it goes up to enough, maybe I'll buy a beach house with cash or something. That's all. I'm not doing it for anything to retire or send my kids to college or anything. So it's fun. I think it's going to continue to go up and down and go up way higher than it has in the past and continue to be a decent investment. But yeah, it's always got that risk of going to zero and being manipulated. So I don't tell anybody to invest their savings in it, but it's fun.
Yeah.
I'll have to shoot you guys. I got an awesome text from my buddy of a YouTube video that's 2 minutes long. It's the Ford versus Ferrari movie. And it's they're overlaying Bitcoin bro stuff on it. And so at one point, Matt Damon steps to the edge of the track and he's talking to his guy in the Ford car and he's got a sign up. And I don't know what the sign says in the actual movie, but it says, "Institutions are in, dude." And all of a sudden you see him shift gears and just start around all the cars. I was literally laughing out loud when I watched it.
Speaking of institutions they're in, one of the headlines this week is Bitcoin ETFs hit record volume as single day high of 612 million pours into BlackRock. So on Thursday, BlackRock received a record 612 million in Bitcoin ETF and crossed 10 billion in assets under management, a day after the asset class hit a high of 7.7 billion in trading volume. Volumes reached 4.7 billion yesterday as the frenzy continues to track investors. So
Yeah, I want to talk a little. So you can speak on the ETF side a little bit more than just general Bitcoin. So what are your thoughts on all that? Because Taylor, we've had some chats before. It was one of those things where this was looking to get approved, and it was one of those old, you buy the rumor, sell the news. Like it went up, and as soon as it like officially was approved, which everyone knew it was, everything it dropped pretty substantially. So that was one of those sayings that I learned from Taylor as well. You buy the rumor, you sell the news.
That's an old Wall Street adage. Yeah. No, it's interesting. So one of the things that maybe the end public doesn't really know at this point is also these things haven't been turned on yet at the wirehouses. And the wirehouses are, so Merrill Lynch, Morgan Stanley, Wells Fargo, UBS, those are considered wirehouse firms, the biggies. They are not able, their financial advisors are not able yet to purchase them in their client accounts. So that's another like big thing that people are weighing on to say, hey, when the wirehouses start piling in, man, you could see these ETFs ramp higher, buying more and more Bitcoin and sending it higher. And again, this might be one of those things that's buy the rumor, sell the news too. Like a lot of the smart money in the Bitcoin space knows that's going to be the case and are pricing it accordingly. But nonetheless, you should see an influx of buying on those ETFs based on that.
Can you explain, and you did this to me a while ago, so I understand it. Can you explain kind of the public what like an ETF is and how like Bitcoin's its whole thing on Coinbase and all these Robinhood, all these other like platforms, and now it's an ETF through like, bigger firms. So can you kind of explain how that process works, that Bitcoin has became an ETF and kind of what ETFs are?
Yeah, so ETF is not, or Bitcoin is not a traditional ETF. Essentially, I'm not going to do this justice, but an ETF is simply a way to access something, so you're not going out and buying it on cold storage and things like that, or going through some knockoff, exchange firm that is, I don't know, so Coinbase isn't knockoff at this point, but you get the point of that. What this does is leaves it readily available on the New York Stock Exchange. So anyone that owns any type of trading account, whether it's Schwab, Vanguard, whether it's at these big firms, they all can access it without opening a separate Coinbase type account to go ahead and buy it in that direction. So it just provides a higher level of accessibility.
Okay. And then the Bitcoin just got approved through the SEC to be an ETF. So I guess that's just a process of the SEC looking at the fund. Like how does that, because not everything can get approved to be an ETF, correct?
Yeah. Next time we're going to talk all about Bitcoin. Give me some context so I can do a little work on
We're
this
almost
before just
done.
coming
This is
on
the
and
last
pummeling
question
you with
about-
this
we don't know
information.
anything about Bitcoin either.
So you could literally just make something up and we would not know.
And still, your thoughts on Bitcoin compared to like the general population is probably much more well thought out. So we appreciate whatever angle you could give us here.
Yeah. So reiterate that last question to me real quick here.
So just in general, I just don't even know the process of like Bitcoin being approved as an ETF. I don't even know what that statement
gotcha.
means. That
Yeah.
or that. Yeah.
Yeah. So normally when you launch an ETF, what it does is goes through SEC regulation. And so what they do is they have every ETF has a board of directors that looks at the underlying risks of the holdings, et cetera, and says, okay, this is sufficient risk metrics. These has the bright bells and whistles on it to defend the underlying clients that buy it. I don't know that that's all that pertinent to Bitcoin. The big difference in Bitcoin and what the new ETF versus the old ETF is that the old ETF was not the spot price. So literally right now, the exact price of Bitcoin is accessible in an ETF. Now, my huge underlying question is, does that really make that big of a difference than what the past ETF accessibility was, where it was buying Bitcoin, not at spot price? And I don't know. It's still access to Bitcoin. It's just, this is a little bit more of an efficient vehicle and giving you specifically what today's price is. The other did a good job of that, admittedly, but it may have been fractionally off on how much it went up. If Bitcoin went up 5%, maybe it went up 4.95% or something really close. With the volatility and the magnitude of move in Bitcoin, I don't know that minute differential is that big of a difference, but this is a momentum. This is a rumor-based asset because there's no underlying fundamentals to it. So if the rumor mill starts picking up, Reddit starts picking up, all these folks start getting involved. Now the institutions are involved too. Listen, smart money, big time money, they get FOMO too. They got FOMO right now, and they're propelling this thing higher.
Yeah, no, I agree. So we can stop with
let's stop to Bitcoin, but let's other side of financial market. Let's just talk about the stock market in general here, Taylor. What S&P is up about 5% in the past week. S&P 500 about almost 8% year to date, and in the last year the S&P is up 30%. Tell us what is going on with the stock market right now, and is this just this pie in the sky thing that's going to all come crashing down, or is this going to continue throughout the year in your opinion?
Yeah, it's a good question. And again, I'll resort to the fact that I don't have a crystal ball, but I'll give you some explanations and some thoughts from my end. So last year, you kind of hit this environment that I'll refer to as like Goldilocks from an economic standpoint. So you had inflation continuing to drift downwards, and you had economic growth that outperformed meaningfully what the market expectations were. And so therefore, companies' profits, balance sheets, et cetera, really benefited. And you had the S&P 500 for the year of 2023 up 25%. Now, granted, it was on the backs of a year where it was down almost 19%. So it had some catching up to do from what it had lost. But at the end of the day, it was something that not many folks were anticipating. And again, that Goldilocks scenario is what played out last year. Inflation down, economic growth positive. That's really good for stocks. Now, just for context, the stock market is expensive right now. And that's not my opinion. That's looking at the data. So the way you measure how inexpensive or expensive stocks are is a metric. There's lots of them to look at, but the main one that people look at is called a price to earnings ratio. So it looks at the S&P 500 and it says for every dollar that companies in the S&P 500 produce on earnings, how much is the market paying for that dollar worth of earnings? So historically, for context, it's right around $15 or $16 for every $1 worth of earnings. Right now, it trades at $20.40 for every $1 worth of earnings. And for context, that puts us in about the top 10 percentile most expensive stocks get throughout history. Now, valuation is awesome because it gives you a really good idea. Apples to apples, are stocks more expensive than they were in 1929 and 1958, 1932, whatever. So it's a great way to look at things on an apples to apples basis. And when things get expensive like stocks are now, there is a tendency for them to revert back to the mean. That being said, it is a terrible timing mechanism. It's not to say things are going to revert back to the mean right now. In 1999, when we had this euphoric .com bubble that was building and building and building, the Federal Reserve Chairman, a guy named Alan Greenspan, said in 1996, a famous quote, "The market is irrationally exuberant." That was in 1996. And the price to earnings multiple is similar to where it is right now at 20-ish times earnings. It went to almost 40 times earnings in 1999. So he said 3 years before that people are crazy, and it continued to get more and more crazy. The market went on a moonshot for the next 3 years as people were crazy, but people made a lot of money. And then in 2000, 2001, 2002, the market melted for 3 straight years and the .com bubble burst. And so, again, it's not to say that valuations are, hey, if stocks are expensive right now, that all of a sudden the house of cards is going to come crashing down. But you do need to start thinking about in the future, returns being more muted based on expensive stocks. And I'll give you one more set of statistics, and I know I'm rambling right now. Historically, the S&P 500 does 10-ish% a year over the long term. When stocks are priced at 20 times earnings, where they are right now, over the next 5 years, at that given starting point, the S&P 500 has produced about a 4% return per year. So that kind of tells you going forward in the future right now, stock returns should be thought to be more muted than they have in that 10% average number that everyone throws around.
Nope.
Yeah, would you think that is from like another bull run of a couple years after that 20 times earnings, and then followed by a decline in prices, and that kind of averages to that 4, you think? Or is it just like kind of muted along the way?
It's a good question. No one really knows the answer to that, but the stock market doesn't work in linear fashion. So it's not like, hey, the next 5 years it's going to 4%. It's going to be 4%,
Yeah.
4%, 4%, 4%. It doesn't work that way.
Yeah.
In all likelihood, what you'll have is the stock market do well or not do well. And at some point, you probably get a meaningful drawdown. And then it hits, more normal numbers on a forward moving basis. And on the average, it's 4%. So there's a great line. There's a great writer in the financial space called Morgan Housel. Named. He's not called. That's his name. Morgan Housel. Morgan Housel breaks things down into like really tangible bites. He's got a great book called The Psychology of Money, and then a second book called Some Things Never Change. No, I'm not promoting this. I don't even know Morgan, but it's just really good writing. And he recently was on a podcast, and I heard him say this: smart investing is preparation through investing, not prediction. And his point to that is like, if you look at the last 3 major market meltdowns we've seen, the last one was COVID. Who could predict that? The one before that was 2008. I a little bit disagree with this one, but in 2008, he said, listen, if Bear Stearns could have bought Lehman Brothers, which the regulators didn't allow to happen, that meltdown would not have been the same as what we experienced. And the regulators said no, stupidly. And the one before that was 2001, when planes hit the Twin Towers. Those are things you can't predict. So don't predict how you invest. Prepare, because what's going to happen that's going to drive the market up, down, or sideways are things that you can't foresee.
Yeah. So you would not consider what happened in 2022 to be a major meltdown. To me, it looked like it was on the tech side, especially where we saw like 60% declines in some of these large tech stocks. And how was that relatable at all to what happened in the early 2000s? Because we were in middle school at that time, so we didn't know what the heck was going on. So
I still don't know what the heck's going on, guys.
Yeah, good point. But yeah, hopefully that rounds out that question for you, Taylor.
I just can't get over the glasses.
My future's bright.
Yeah. So back to your question of like 2022. I think 2022 was largely a function of 2020 and what happened in COVID. Okay. So what happened with COVID was, the coffers were opened. Everyone got stimulus checks. Interest rates were cut down to nothing. They were held at zero for a really long period of time. And then you had kind of another unforeseen: Russia invaded Ukraine, causing inflation to spike seemingly overnight, right? And inflation was building a little bit via the COVID stimulus and fiscal stimulus that came along with it, and monetary. And so that was already building in that direction. And then when Russia invaded Ukraine, another completely unknown, unpredictable, boom, inflation takes off. And that's what caused the meltdown in 2022. And the other thing that caused the meltdown in 2022 was the euphoric run that happened post-COVID in 2020 and 2021. This was the last time Bitcoin was where it is right now. Yeah. Right. So, and I'm not portending what's going to happen in the future here of a meltdown in Bitcoin like it experienced back then. But this is when people start sending you text messages about things. Hey, Steph's getting hot. He's bombing threes. Yeah. Like, start to pay attention. Like, start to at least raise red flags. I'm not saying go and blow out of everything. It's, hey, protect things. Yeah. And you do that. There's ways to do that in the investment universe that people need to be aware of.
Yeah, it's kind of similar to the real estate world. When everybody and their brother wants to flip a house and they think it's cool, then that's usually the time that we're like, wait a second, something's going on here.
Exactly. All right. So 2 things. One, Taylor, every time Luke asks a question, you say good question. Every time I ask a question, you laugh.
You're a moron.
I don't know what that's about, but let me give you both my theory, and you guys can rip it apart on why the general economy and stock market, and maybe it's a theory that's out there. I'm sure it is. But could it be, there's other factors, but could it be almost as simple as there was 80% of the history of the U.S. dollar was dumped into the U.S. economy in a very short period of time. 80% of the history of the dollar that's ever been printed. They just printed so much money through stimulus, through PPP, through all of these things that money has to go somewhere. The fact that there was so much of it there, some of it is going to bleed over to the stock market. Some of it is going to bleed over to other investments that are going to not artificially push it because it's real money going in there. But you see what I'm trying to say? Is that part of it? The fact that just so much money got dumped into the pot, it's going to bleed out into other things and make investments look good. Do you think there's some of that into it?
No doubt. Yeah. There's
a good question by Sam. That's all I'm going to say.
Good question.
You're right. I have said that every time. That is totally subconscious. That's just because I keep looking at you wearing those glasses and going, what is going on here?
I don't blame you at all.
So there's a statistic. Good question. There is a statistic that you can stare at called M2, which looks at money supply, how much money is being put in circulation. And there is a really good overlap between M2, how much money is being spilled into the market, and asset returns. And it doesn't matter whether you're looking at real estate, whether you're looking at stocks, any asset, there is a heavy correlation between the two. And now what we're seeing a little bit is just, and again, I'm not trying to create this scary scenario, is M2 is slowing down. M2 is going negative. And so that comes with, listen, banks aren't lending as much anymore. And when banks aren't willing to lend and fictitiously create money, and I don't mean that in a bad way, that's what they're doing, is they're going out and creating money for folks to go out and spend in the economy. Right now, banks have tightened the old strap. And so they're not as willing to lend and things like that. The Federal Reserve went from putting money into the economy to sucking money out of the economy with raising rates and also with their quantitative easing, now quantitative tightening process. And so all of those things, took liquidity, to your point, out of the market. And to your point, there is a very heavy correlation between asset prices and liquidity. If you were to invest based on one thing, Sam, that would not be a dumb approach.
Nice. All right. I like it.
Work.
Good for me.
Yeah, proud of you.
Yeah, so I to piggyback off that a little bit, Taylor, banks are tightening the strings a little bit, but also the interest rates are making it less appetizing to borrow money. Like Lucas and I, and it's a good thing because of kind of how quickly we grew. We're dealing with that's a whole nother episode of all the growing pains we're dealing with for buying $25 million in real estate in 13 months and how much we're dealing with the fallout of that. But in general, it's like harder. Like we don't borrow as much money because the deals don't make as much sense. We're not buying apartment complexes. We're not buying as many big assets because it costs us 8% as it used to cost us 4%, and it won't cash flow anymore. So there's the bank tightening, but also the investor tightening of, hey, deals don't make sense when money costs this much. So there's that side of it as well.
Yeah, I mean that's half the reason behind why houses aren't turning over these days, because people can't afford to do it. You guys know this space better than I do. The one thing I'm interested in seeing is, and you guys can pontificate on this as well if you have any thoughts, is historically when you look at mortgage rates, they're set off of where the 10-year Treasury bond is. So the 10-year Treasury bond right now yields 4.20. There you go for your glasses. 4.20 is about where the 10-year Treasury is, and usually there's 130 and 130 to 160 basis point spread, which would put a 1.5% on 4.20. So you're at 5.70. You guys know mortgage rates are significantly above that right now, and I'm talking about residential here, not on investment real estate like you guys are purchasing. So that would say if 10-year is here, that the average 30-year mortgage that an individual buying a home for a primary residence would be right around 575, somewhere in that ballpark. Right now, it's meaningfully above that. And one of the reasons that's taking place is because banks are trying to measure their risk, lending institutions are trying to measure their risk, and with interest rates having been so darn volatile because inflation's been so darn volatile, what they need to do is build in a bigger layer of safety there, and they're not going to take that risk on their book. They're going to push that through in pricing, and there's a wider spread than historically normal. And so as interest rates settle in and as inflation, we get a better beat on where it's going to be in the future, you should see some compression there, I hope, and I hope to see mortgage rates come down for folks. And you guys would obviously love that as well, right?
Yeah, that would open up the floodgates a little bit. I think Lucas talks about this. In 2023, there was less real estate transactions than in 2008. That tells you how suppressed the market was, and the market wasn't turning over as far as just a transactional basis. So that tells you how 2023, the pricing, has been pretty good for most markets. But as far as on a how many houses were sold basis, it was less than 2008, which is pretty crazy to think about because interest rates are higher, and people don't want to leave their 4%, 3% interest rates.
For sure. So yeah. Oh, sorry.
Go ahead,
Taylor. Go ahead, Taylor.
Yeah, I have a buddy who says, listen, there was a recession or a depression in real estate. You just didn't realize it. It wasn't in the price of homes. It was in the transactions.
Absolutely. And a company like ours, which is highly transaction focused, we definitely felt it last year, no doubt.
Yeah, we went from 312 houses in 2022 to last year 170.
Yeah, it was 170.
So I mean, still a lot of houses, but man, that's a 40% drop in transactions.
Yeah.
Fortunately, our profit per deal was double what it was,
Yes.
but still, it's just a big drawback on transactions for sure.
For sure. That spread that you talked about, Taylor, that's something we watch, on a daily basis, probably. And our thought process is very similar to yours. Is we're hoping that margin compress as interest rates from the federal government from the 10-year haven't. I'm sorry, where am I going with this? Hopefully that spread goes down here as interest rates kind of stabilize, right?
So they don't even have to drop. You just have
Exactly.
to not. They just have to not predict a future. They just have to have a better feeling of where they're potentially going. They're not going to go up anymore. They might not go down, but as long as they're going to stay where they are, we can compress our spread a little bit and take the risk out and do more deals because they're not going to do as many deals until they compress it.
And we haven't had a raise since July.
Yeah, I think
of 23. And we just got quality core inflation data this week. We just got good, quote unquote, job reports this week. So just talking to you, Taylor, here, and obviously I would love your thoughts, Sam.
I'm ready,
your thoughts.
Lucas.
What do you think what do you think this looks like for maybe what the federal government is going to do with interest rates as we're seeing quality inflation reports come? Are they going to try to get ahead of it and start rate cuts sooner rather than later, especially with like what we're seeing in Bitcoin and these hot financial markets on top of that?
Yeah. I've been in the
Don't
camp.
Good question. All right, good. You didn't. Okay.
Good
sorry.
question. No, that's an amazing question.
Oh, shut up.
Amazing question. Yeah, I've been in the camp for a long time now that we aren't going to get as many cuts this year as what the market anticipated. So the market was saying, 3 months ago that we were going to get 6 to 7 interest rate cuts this year. And I'm looking at it going, listen, they're still talking about scares of inflation and potentially rates going higher. So I thought that was crazy. But on the other end, one of the things that's a huge component, and I'm interested to hear your guys' firsthand experience with this. One of the things that's a huge input component, the largest by far, is owner equivalent rent to all the inflation metrics. And it keeps going higher. And then when you look at some of the other indicators of this, like Redfin and Zillow put out their information on rents, and they're actually seeing rents come down a little bit and have now for the past 5-6 months, but it hasn't bled through to what the Fed measures with this owner's equivalent rent. And so a lot of the forecasters are saying that, listen, this is coming through the system. That housing or shelter component of it is going to leak down. It hasn't done so yet. And if it does, that's going to bring the inflation metrics that the Fed looks at very closely down along with it. So if that's the case and that starts to play out more quickly, which it hasn't yet in the data they look at, then that will give them a little bit of solace to go out and then cut interest rates maybe more quickly than what they're anticipating at this point.
Yeah, so Taylor and I have had this talk for a while now, via our lives, that everybody got a little bit bullish on what they thought the rates. There's very, very unlikely scenario that rates were going to be cut how people were predicting. Plus, we had completely opposing predictions, right? We had people predicting, I think, Taylor, you can quote me if I'm wrong, a 12% growth in the economy, yet also 6 or 7 price drops, and they both can't happen at the same time. In order for the interest rates to go down, that would mean we wouldn't have to have big earnings. If we have big earnings, they're not going to drop rates, and that's what's played out so far. Good earnings, no rate drops. Can you kind of elaborate on that a little bit? Of that amazing question I just had.
You listen well. I'm impressed. I will twist your words a little bit and say that you're almost spot on in saying that corporate earnings were the expectations to grow 12%. And so with that, again, you can't measure corporate earnings being up 12%, or you can't right the ship and say, yeah, that makes sense. At the same time, on the other side, the Fed thinks they need to stimulate the economy. And so what's happened is corporate earnings have been pretty darn good. And I will caveat and say that when you look beneath the surface, I think they've been not quite as good as what the market has responded to. But nonetheless, NVIDIA, that was the only one anyone cared about. I've never seen in my career so much focus on one company's earnings as I did on NVIDIA. And literally, it monumentally moved the entire market the day after earnings. Like, it moved the market cap of NVIDIA by something like $250 billion.
That's crazy.
That's larger than Target. That's larger than the company of Target in one day. And so, like, it's just crazy how much it moved. But that was like the epicenter of focus. But back to your point, Sam, which was an amazing point, was you could not get 12% corporate earnings growth and also 6 or 7 interest rate cuts. It just, the math doesn't work.
Well, don't hate on our Target. We own some Target here at Prosper Companies, but yeah.
What I was getting at is the magnitude of the
I
move.
know.
The corporate, the addition of valuation on NVIDIA surpassed the entire value of the company of Target.
That happened with Meta
Correct.
a month or two ago as well.
Correct.
It was a very similar couple $100 billion jump in one day.
Yeah, it's nuts. Yeah, we have we talked a little bit, Taylor. We have started an investing company to invest in markets and potentially companies and things with some of the profit from our companies. And one of the things we do is you invest in the markets a little bit. And when Target kind of stepped in it from a publicity standpoint several months ago, and their price went down, we went ahead and bought some. So
yeah, we think.
Decisions.
Not me.
Myself and Phil Blackwood, who's our one of our analysts here. He's more real estate focused, but we read The Intelligent Investor by Ben Graham.
you're
and we
You're
think
good!
We think we're experts.
You're
so
good!
yeah, we're not
And
like
we use his like stock picker that book provides.
I mean,
or
we
something
probably
like
bought $5,000
Yeah.
of Target stock when it was down, right, or more.
that. Maybe 10.
I don't know where my money goes, but anyways, I trust Lucas, so we're all good. So yeah, so that is just interesting, and a lot of it's played out to where there's the extremes on either side of things, and through our conversation, Taylor, I know you're more of like, yeah, most likely things are in the middle as far as the predicted corporate earnings as well as the rate cuts. Nobody has a crystal ball, but I don't know that I'd even predict a rate cut at the next meeting, but I could see
I
one or
wouldn't
two.
in March.
I could
wouldn't
see
in March. No.
if you force me to predict, I'd
That's
predict
this
one or
month.
two rate
That's
cuts this
crazy.
year. That's what would you predict, Lucas? And again, we know that we're just guessing.
These cuts that we're talking about, they're going to be so minor.
Quarter, whatever, yeah.
So I could see if we keep having quality reports come back like we have this past week, month over month over the next 2 months, I could see it in May being a first like quarter point, half point. Personally,
What are you seeing, Taylor? I mean, again, we know your guessing. What are you guessing?
Yeah, I think that I'm in your camp, Sam, 1 to 2. So here's the interesting thing. Right now, the market's moved from 6 to 7 interest rate cuts to 3. That's what's being priced in this year. That's what the expectation is. And the stock market has continued to go up. And so when you rewind back to last year, the market started to rip in October, because October 31st, I think, was when the Fed met, and the Fed said, hey, we think we're done with interest rate hikes, and we probably won't need to do any more. So the market said, oh boy, here we go, baby. Interest rate cuts coming. We'll price in 6 or 7 of them. And that took the market up like 14% in the fourth quarter. And now the interesting thing is like, okay, fast forward, we've taken 3 or 4 of those off the table, and the market continues to do this. Like, why is this a one-way street where it's really good when there's more interest rate cuts starting to get jubilant in the market, but when you take them back off, doesn't matter. Whatever,
It's
let's
still
keep
good,
rolling.
right? Yeah, that's what we talked about. A lot of the fundamentals don't make sense with what's going on in the market. That's why a lot of your videos haven't been you're not painting this like this doomsday scenario, but it's just like, hey, be observant of what's going on. This is a little bit uncharted territory. There's always, every single year is new because there are different factors, right? There, you can't ever compare year over year, but like there's just some funky stuff going on, and not saying it's going to drop off of a cliff, but this is an odd time we're in right now. Things don't always make sense.
Yeah, and I'll say this part too, like soft landing is the narrative right now, right? Soft landing is going to play out. That's what the market's saying. It's always soft landing when you go into recession. They're always talking soft landing. And there have been very few times when we've been able to effectively navigate a soft landing. And everyone thinks it's a foregone conclusion that it'll happen this time. And it very well could. I'm not saying it's not. But 1994 is about the only time in history where you could see inflation pick up, the Fed raise interest rates to track it down, and effectively not enter us into a recession. So we'll see. It certainly could play out. But, if you're betting on history, I wouldn't bet on a soft landing per se. And it's not to say if we do go into recession, it has to be this bloodbath like it was in 2008. Like, that was a nasty recession. It felt like the world was literally crumbling. Our financial system started to have massive question marks as to whether all of the banks that were going to go under. Wachovia got bought by Wells Fargo. It was a massive bank at the time, and it needed a bailout. Warren Buffett steps in and bails out Goldman Sachs, the institution of them all. And so it's not to say it needs to be like that, But for us to just say, hey, things are going to be steady as she goes, I think that there needs to be some reality in the fact that history doesn't indicate our ability to navigate these interest rate hikes without some sort of mild recession coming on the back.
For sure. Yeah, I get that. And you know, we're business owners here, and we're also in real estate, but I just know what it felt like at, you know, late 22 through mid 23, and it freaking hurt. You know what I mean? It was painful. So for people to tell me that wasn't a recession is that you're lying. Like, that was a recession.
For us, we got kicked square in the nuts. We lost several $100,000 in our all of our companies over that period. Luckily we have multiple companies, but yeah, it was bad. Like, and if you look at just the median house price from whatever the height was to what it dipped down to, it dropped like 75 grand. And from whatever that was the biggest like price drop ever, even through 08 in that period of time. And I get it was on a higher number, so the percentage, I don't even know the math, but that chart is insane after the median house price after 2020, and then a complete what's the opposite of rip, went all the way down and then it up and then it's back down again. So the real estate market and fewer transactions, so I guess not everybody felt it, but we've been kicked
and
pretty
it comes
hard.
in different shapes and sizes depending on your industry or type of business or all that. But we definitely felt a lot of pain on the backside of this when they started to raise rates.
Yeah, for sure.
Though, is back to your inflation comment before, Lucas, is like as we've seen median houses come down in price, that would lead you to believe that rents have to come down a little bit too.
Yeah.
And that has not leaked through into that inflation data, which is what we were talking about before, which alludes to you potentially being right, where more interest rate cuts could be in the future than what's expected.
Yep.
Cool. I like it. All right, we're gonna get to we got a few more minutes, then we're gonna get to some ending questions, then we're gonna play Would You Rather, which is a fun game. We have more questions for you, but the one thing I kind of want to get into, which is interesting, is thoughts on the economy over in China. I know we had talks before in China. We had talks before about that they were shut down through COVID, like locked them down, and then they released everybody, and it did not. That we were wrong. Everybody predicted this huge surge, and that did not happen. China has built like hundreds of thousands of buildings and dwellings that nobody's occupied, and there's just a lot of issues potentially going over there. Their financials do not look very good right now from what I have seen. So Taylor, you're much more in tune in that. So could you give us a little bit of your thoughts on kind of where the Chinese market has been recently, how their real estate bubble is kind of fitting into that, and then what that kind of means in the future in, you're just through your potential lens?
Yeah. Good question, Sam. On the front of China, no, it's been interesting because everyone expected this massive surge, the huge positive blowback from China of when they started to release their lockdown, this and that, everyone gets out and starts spending like they did here in the States. That didn't play out. And so China is now experiencing something like a 2008 for us, where you had massive overbuild in real estate. And now the real estate market hit that tipping point and started to come plummeting down on the other side. And Chinese, by culture, they have a tendency to own more of their wealth in real estate than in maybe investments, if you will, more traditional investments like the stock market, et cetera, 401ks here in the United States. And so they're predisposed more so to a downturn in real estate prices than we are here in the States. And so when they started to hit that tipping point, real estate market started to roll over. Evergrande and some other huge real estate companies started to literally go under. It hit that tipping point, and China is now absolutely created a blowout on the bottom side of their stock market. And what's interesting from like an investment standpoint, not to go too far off the rails here, but China's an emerging market, and so emerging markets kind of get grouped together. And so the big emerging markets are the BRICS that everyone talks about: Brazil, Russia, India, China, South Africa. But like India's economy is actually doing pretty darn well right now. And because they're grouped as an emerging market that has this massive downward pressure based on China's economic news, they're seeing a sell-off in some of their things that are unwarranted just because they're grouped into that nature. And so there's some really good investment opportunities in India. And the Indian stock market has actually been able to buck some of that trend and go up. But I think it would have gone up much more had it not been that downward pressure from China. And there might be some opportunity there.
Yeah, and we talked about this a little bit. Everyone talks about the U.S. debt. China's debt to GDP percentage is worse even than the U.S. debt, right? I'm not misquoting that, correct? Taylor?
China's found themselves in a debt issue as well. And it's just a different economic mentality there. You know, large companies can be partially state-run, it can be partially private. From just a business regulatory standpoint, we think it's bad here in the States. And, you know, if you want to go out and build a new building, there's so much red tape and stuff like that. If you speak out against the Chinese government, Jack Ma, the owner of Alibaba, literally disappeared for 3 months. And people were like, hey, he spoke out against Xi Jinping. He might be dead. And that's what the assumption was. And then he resurfaced 5 months later, and he looked skinny as a rail. So that is the difference. We might think that things are onerous and we can't talk about bad things in our own society. It's freedom of speech is a little more serious here than it is over there.
Yeah, I was on a quick story. I was on a podcast with a guy who's lived in Taiwan for the past 30 years. He grew up in the States. He was in California. He was in the tech industry, and he was out there. And he's like, the one thing noticed from living there and living abroad, like no country takes freedom of speech like the United States. Like you guys think that there's this like, you know, you can't say certain things and there's backlash. No, compared to what other countries do, what you talk about China with the Russia. What's that gentleman's name? Alexei, with literally it appears that Putin had him killed in jail because he was maybe going to beat it. Like, it's like I know the U.S. isn't perfect, but there's nowhere I'd rather be. So anyways, that's
like
interesting.
That Shane Gillis.
You love Shane Gillis.
Oh,
he's
so
not even
funny.
going to be able to tell the story, fucking Taylor, because he can't tell a Shane Gillis story without laughing a million times in the middle of it.
This one's not like super funny, but he talks about like why United States is the best. He's like, I get off the airport and he's like, this is your country. He's like, this sucks, dude. He goes, I've been to 3 countries. It's official. We're the best.
Yeah. Yes, I would agree. Taylor and I have that talk a lot. Not the best, but the economy, the underlying, our fundamentals in the military, we're in a good spot. All right, so let's get some ending questions, and then would you rather. So I know you probably hate this question, but you're getting the money. You're not telling me what to do with my money. So these are 3 questions we ask at the end of each one. If I gave you $10 million right now, what would you do with it?
I would invest it in a diversified manner.
Okay. You wouldn't like go buy a house, pay off your car. You just would.
You're saying what would I do with the money personally?
Giving you $10 million. Yeah, I'm giving you personally $10 million. So again, this is a question for you, so you can answer it. I'm giving you $10 million cash. What would you do with it?
Yep. So the first thing I would do, because I've wanted to do this, buy a golf cart. My community would be awesome if everyone had golf carts. So
there you go.
Bang.
You would buy golf carts for your whole community? Is that what I heard?
Yeah. If you're giving me 10, I'll buy all my friends golf carts. We've got like 4 or 5 little families. We can all roll around on golf carts. It'd be amazing.
You live in like big trees and mansions and castles and stuff. You all can afford golf carts out there.
Okay,
Frugal is sexy, Sam. Frugal is
like
sexy.
$70,000, Taylor. What about the other 9.9?
I'd be boring, dude. I don't need anything else. I guess I'd try to take a vacation. Maybe that would be it. Then I'd invest the rest in a diversified manner, like a total nerd.
What would be that diversified manner? Kind of what you talked about in the beginning of the show, Taylor.
Yeah. So it would be, Jesus, don't make me say all this boring stuff again.
No, I freaking
Stocks,
love
bonds,
it,
alternatives, all of it would be invested.
So
we let it go, and then I'd be able to retire 10 years earlier.
You'd 60-40 it, and man, imagine if you used that $10 million to buy a $50 million apartment complex, you'd be set for life. All right, so Taylor,
imagine if I bought Bitcoin, dude. I'd be rich tomorrow.
Hey, there's fundamentals behind real estate that you enjoy. All right, you notice we didn't do a lot of real estate talk on purpose with you, so we didn't want to fight you. All right, so what? Lucas, you asked this question. Explain why I'm asking this next question, because we do this on a weekly basis with our team. Yeah.
So why don't you ask the question? I'll ask it. What are 2 words you hope people would describe you as, Taylor? We do this with all of our team members, and we put them on the spot, literally in front of our whole company. I think it gets to. It allows us to know what's important to you, Taylor. And then it's also like usually one of the 2 words to describe yourself is something that you are right now, and the other one sometimes it's something that you're striving to be. So it's kind of interesting to see. So 2 words that you hope other people see you as.
Yeah. So these are the first 2 that popped in my head. So genuine and tenacious.
Those are good ones.
Those are great ones.
Those are great ones. Yeah. So we do an employee spotlight because we got 40 whatever team members, and once a week we have our meeting all together, and one person talks about they do a show and tell or whatever, and we ask them to in front of everybody to say the 2 words. It's always interesting, but those are good ones.
Well, I think you're both of those, Taylor. So whatever that
And
for whatever that's worth.
And
Oh, you said on both those things. So
Yeah,
listen,
I
I got
think
you.
so.
I got you fooled. I got you
Yeah.
fooled.
Yeah.
He fooled me the first couple times, but now I know.
Now
He's
you
just a
know.
big old dweeb.
All
All right.
right.
So, what is the single thing that you are most proud of when you think about your life so far?
Not your 6-month-old. We know that.
I know, man. Like the
Not
thought
yet.
immediately goes to like my wife, my family, my this, my that.
That's not a bad one. If it's
Now you know what, and that is it. But I think on top of the wife, the family things, and that, one of the things I've done is here I'm just patting myself all over the back right now. One of the things I've done is created like an amazing network of friends. Like and y'all get grouped into that. But even like my closest friends, everyone else comes around and like they hang out with us, this and that. And they're like, dude, you have an amazing group of friends. Like just fun people, fun loving, genuine people, some tenacious people in
Yeah.
there. But in reality, like it doesn't matter your socioeconomic. Like some of my friends are loaded, some of my friends are poor. And like it doesn't matter. That doesn't make any difference. It's genuine people that like love each other, like hanging out, like shooting the shit, like being laid back, having fun.
Yeah, I
I
think
like
that's an ASAP Rocky line. My rich friends and my poor friends get along. So,
There you go.
yeah.
I like it. ASAP Taylor.
Yeah.
Awesome. All right, great. All right, so now we got a couple would you rathers we're all going to answer, and then we'll get you out of here in about 8 minutes and plenty of time. All right, so I'll ask Taylor this one first. We're
Yeah.
playing would you rather. All right, Lucas, you answer too, and I'll answer as well. So Taylor, would you rather live in a house covered in floral wallpaper or brightly colored wall paint? So you're living in a house with floral wallpaper everywhere, or a bunch of yellow and green walls?
Oh, dude, give me the floral wallpaper. At least break it up.
Yeah. What do you think about that, Lucas?
I cannot live with floral wallpaper. It just feels too old and dingy.
So you're
to
gonna have
me.
these
I'm gonna
these
have.
lime
I'm gonna
green
go
walls?
bright. I can wear those cool sunglasses like you got all day, and just just full of energy.
So, by the way, my mentality when you asked that also must have blended the two, because I was thinking not like that old school 70 nasty, like dingy burnt orange. I was
Yeah.
thinking like
Some badass.
bright pink flowers with green lining.
Yeah.
Like that was where my mind went.
No,
for the
you're like
record.
all like your collar inside of your collar, straight walls or floral. So
Well, I'm not doing that. I'm doing floral walls that are this color and
Yeah, you're doing
pinks and
both.
like.
yeah, he's doing both. What a psycho! All right, what are? Oh yeah, Luke, you can do the next one.
What about you? What was your answer?
I'd probably do the floral. Like my eyes right now hurt so bad, and they're like just watering. I can't imagine looking at freaking neon wall right now.
I can't imagine looking at you right now.
I know it look cool, don't I?
Yeah. All right, next one. Would you rather wake up in the morning as a bird or a dolphin, Taylor?
He's like,
Can I
he's
pick
like,
an otter?
know, I
An
was getting
otter
used
is where I would like to take this, because that would be my best day, is being an otter. But definitely a bird, I would say, over a dolphin. Dude, I'd be cruising around like an eagle way up high, seeing everything. Be awesome.
Yeah, it'd be sick.
What about you, Lucas?
Well, I think I'm going to go dolphin. They are the only
I know where you're going with this.
I know where you're going with this, too.
Either other animal or other mammal that has sex for fun.
Yes.
So,
So that sex is an important part of your life, Lucas.
hell yeah, it is.
Ashley, are you listening?
And they're super smart, right? And they can like kill sharks and stuff.
This is a good one because dolphins are like the most dangerous animals in the ocean because they're so smart. And yes, they F for fun, which is a big fun thing. I mean, but if I'm an eagle, I can still do it for fun if I want, right?
So
I mean,
maybe an eagle. I guess I was going like when I hear bird, I'm thinking like a blue jay or a robin.
but like if I get where you're going with that. Dolphins, the water's amazing, and they're smart. But like if I'm a bird, I'm like using my brain, so I'm still gonna take my wife bird and do that still. So
yeah, I mean you're
do
just
birds do that? Yeah, or no, they just go on eggs.
very animalistic approach, right? That's what a bird is. Like they don't know anything else besides like just flying,
Yeah, I don't think they're
eating,
super
and
smart,
and
no.
yeah, that other thing.
My answer was an eagle. You know what eagles do? They catch each other in the air and grapple, and they fall all the way to the ground. Then they do it.
There you go. Ooh, that's how. Isn't that how
Love
you
it,
guys do it?
dude.
That's how I do it too.
Yeah, that's how it
Me and-
works in
me
my
and Courtney
house.
just grapple
Yeah.
and go to the ground. Okay. All right. Last question. Someone is about to take over the world. Would you rather it be aliens or robots?
Robots, aliens, they scare me. They weird me out, and I don't know where you're coming from. We can train the robots, I think. So the aliens, they come down. I don't know what to think, man.
The robots is going to happen,
Yeah,
so we better get used to it.
Figure that part out.
Well put.
Yeah. What about you?
Robots. That's why.
I don't know. Aliens would be so interesting, though.
Yeah, like we always talk about this, like what does an alien look like? We
Yeah.
have this idea, but it's probably just like this blob of organisms. On the
Yeah, we're
ground.
like, there's no way they're the odds of them being like carbon based like us. Like, are they really small or our size or really big or you know what I mean? Like, you have no idea what else is out there. So, I mean, honestly, if they take over the world, either way, we're fucked.
We're screwed.
So I think it'd be interesting to see what aliens would do with it.
Would
because
do to
I know
us.
robots are gonna do. They're gonna like, you know,
they're metal.
yeah,
more than
order
They're
us
gonna do
around.
our shit for us. That's what they're gonna do.
Well, not
Yeah.
if they're taking over. We're saying they're like the bosses. They're like running the world. So
Yeah, I feel like in order to, prevent the aliens from continuing to rule us, we'd have to
Great.
like kill them all, right?
Yeah.
But the robots, I feel like we could train them or hack into their infrastructure and train them to work for us.
they're smarter than us.
Yes, they are.
Dude,
Yeah.
Sam's a tech genius. He can definitely hack
Yeah, I
into the
can
back
figure
end.
it out. Yeah, for
Go
sure.
to Sam Chat. What is it?
Samchat.io. It's an AI chatbot with my brain in it.
You are.
Samchat.io.
Oh
there's
God,
the plug.
I'm gonna get over there. It's gonna be interesting.
Yeah.
Just yeah,
Yeah, you
Samchat-
should like mess with it,
Yeah.
Taylor. Like, why are stocks better in real estate or something like that? That'd be
Yeah,
funny.
Samchat.io. It's a legitimate site that's that has all of our YouTube videos subscribed, ran through OpenAI, and any question anybody asks, they get our answers on. So
Dude,
I am
love
a tech
it.
genius. I am a tech genius. All right, perfect. So we're getting ready to roll out of here. So what's going to happen now is I guess you'll be able to see us, maybe not, but we are getting ready. You might be able to see us. We're getting ready to throw our outlines in the trash can. I believe I'm ahead of you one time, right?
You are. Yeah.
I'm ahead of Lucas
You're
by
up
one. So we
You're lucky.
unwind, we go back there, so it's like a free throw length. So Tay, we'll let you announce. We'll do the shot, then we'll roll out. It was good chatting with you, man. Appreciate it. If anybody wants to reach out to you because you have a legitimate, a financial planning service, what's the best place to reach out to you? Is it Instagram or why don't you plug it for quick here a second?
Yeah,
Give
go
it
to
a little
Instagram.
plug.
It's the easiest way to see a little bit about what we're about. At
Taylor
Life
Sohns,
Goal
Life
Investments, man.
Type in Taylor Sohns or Life Goal Investment and do it. All right, so you can do. Luke's going to shoot first, so he's the college basketball player, but I'm beating him in this right now. Did it miss?
No.
And when it hit the rim, he hit the rim.
I hit the rim and it trickled in.
Rim job. Luke's all about rim jobs. All right, here we go. Watch this, Luke's ready?
All right, here goes Sam.
Are you looking at me, Lucas? Ready?
Sam closed his eyes to try to be cool and missed it, but with his eyes open, I don't think it would even help him the way they look right now.
He got cocky. He got
did
cocky.
He tried to Jordan it.
All right, thanks, Taylor. Appreciate it, buddy.
Yeah. Taylor, appreciate you today, man. Take it easy, brother. Good luck on your next call. All right, man. Yep, see ya.
From our conversation. If you love what you learn, make sure you like, rate, review the show, and help us spread the word by telling a friend.
If you'd like to learn more about working with me inside one of my programs, we'll have those links in the show notes, along with all our social media handles, so you connect with us there for free. If there's a real estate question you'd like us to answer, feel free to send us a message and we'll cover it in an upcoming show.